What is short interest ratio? Short squeeze. Citron Research. A short squeeze is a rapid increase in the price of a stock owing primarily to technical factors in the market rather than underlying fundamentals. A short squeeze can occur when there is a lack of supply and an excess of demand for the stock due to short sellers covering their positions. Short squeezes result when short sellers of a stock move to cover their positions, purchasing large volumes of stock relative to the market volume. Since covering their positions involves buying shares, the short squeeze causes a further rise in the stock's price. This newly increased price can, in turn, trigger additional margin calls and short covering, which in turn may drive up the price further, still in a vicious feedback loop. Short squeezes tend to happen in stocks that have expensive borrow rates. These expensive borrow rates can increase the pressure on short sellers to cover their positions, further adding to the reflexive nature of this phenomenon. Day traders via Reddit board and Robinhood have defeated Wall Street firms like Citron Research in trading of stocks like GameStop and exposed short squeeze. What is Citron Research? Citron Research has been publishing columns for over 17 years, making it one of the longest-running online stock commentary websites. With over 150 reports, Citron has amassed a track record identifying fraud and terminal business models second to none among any published source. The goal of this website is and has always been to provide truthful information in an entertaining format to the investing public. Our goal has never been to engage in gotcha journalism. Readers are always encouraged to consider this and all information available regarding any potential investments, to seek professional assistance as necessary, and to draw their own conclusions. Citron Research has been voted #1 activist short seller by the Activist Investing Annual Review 2019. What is short interest ratio? The short interest ratio, also called days to cover ratio, represents the number of days it takes short sellers on average to cover their positions, that is, repurchase all of the borrowed shares. It is calculated by dividing the number of shares sold short by the average daily trading volume, generally over the last 30 trading days. The ratio is used by fundamental and technical traders to identify trends. The days to cover ratio can also be calculated for an entire exchange to determine the sentiment of the market as a whole. If an exchange has a high days to cover ratio of around 5 or greater, this can be taken as a bearish signal, and vice versa. The short interest ratio is not to be confused with the short interest, a similar concept whereby the number of shares sold short is divided by the number of outstanding shares. The latter concept does not take liquidity into account. What is short squeeze? A short squeeze can occur if the price of stock with a high short interest begins to have increased demand and a strong upward trend. To cut their losses, short sellers may add to demand by buying shares to cover short positions, causing the share price to further escalate temporarily. In markets with an active options market, short sellers can hedge against the risk of a short squeeze by buying call options. Conversely, short squeezes are more likely to occur in stocks with small market capitalization and a small public float. Hashtags short interest, day trading, Citron Research. What is short interest ratio? Short squeeze. Citron Research.